So the goal of most real estate investors out there is to create a passive stream of cash flow, perhaps enough to retire on one day. Well, what we're going to be talking about in this video is how you could potentially reach early retirement through savvy real estate investments made earlier on in your life. Now, myself personally, I am 27 years old and I already have 3 real estate transactions under my belt. One being a multifamily property, one being a single family property, and then one being a piece of raw land. So I have personally had a lot of experience in real estate over the last few years that we'll be leaning on, as well as a lot of other relevant sources related to building up a possible retirement from a real estate portfolio. Now, first of all, why would somebody choose real estate as their investment vehicle when it comes to income for retirement? Well, number one, it's something that is really easy to understand because you are essentially providing housing. Now, there are ways that real estate can get very complicated with types of debt investments or getting into, raw land development and things like that. When it comes to rental properties, you are essentially just buying real estate, renting it out to people, and then making repairs on the real estate as needed. Now, another reason why people like real estate is because it can provide passive income. Now, we just talked about in a recent video on real estate versus stocks, how real estate really isn't truly passive income, and that is because when you are a landlord like myself, there's always going to be some active duties involved with your property. Now, if your goal is to get up to 30 or 40 or 50 units and then bring on a property manager, well, that's probably a great idea for a retirement strategy, and at that point in time it could be completely passive. But I would just say early on, when you get started with real estate, don't expect it to be passive right out of the gate, but it certainly can become that down the road. And then third and finally, it's sort of a fast track method towards retirement, because if you want to retire through the stock market, you usually have to invest through something like a 401k over a period of 40 or 50 years. But with the right market and many different factors, you could retire through real estate investing in as little as 10 years. So that's one of the things we're going to be talking about here, is how real estate is actually a fast track towards retirement versus many other investment options out there. Now, another reason why people invest in real estate is because nothing else out there has remotely made more millionaires than simple real estate. 90% of millionaires over the last 200 years were created through real estate. Now, no, that doesn't mean mostly real estate developments or people working in real estate. It means the growth of a person's net worth by simply owning real estate over the long run. Now, that being said, although real estate is largely an equal opportunity available to everyone today, not everybody out there is going to have the discipline required to get into real estate in the very first place. That is because securing your very first real estate investment is undoubtedly going to be the most difficult part of the process. A real estate deal is going to require you to put down anywhere from 3 to 20% down, with 3% as well in additional closing costs. Not to mention, if you're talking about a rental property, that is going to be a commercial loan in most cases. That could be as much as 25% as the required down payment on that purchase of the real estate. In addition, you have to have the discipline required to build an outstanding credit score, and so that's going to take many, many years of prior work and making sure you take the right steps early on. Third and finally, you also have to have the right amount of discipline to avoid the bad deals. So myself personally, when I first started scouting real estate deals for a rental property that I was going to own or occupy back in 2018, I spent almost an entire year finding the right property because I kept looking at ones that just were not the right fit for me. Had I settled before, I probably would not have done nearly as well in terms of the appreciation that I've seen on my rental property that I bought back in 2019. Now, early retirement is something that most, if not all of us, want to achieve, but you can't get anywhere that you're trying to go without a set plan. And so what we're going to go over here is a simple 5-step plan to early retirement. So number one, you obviously have to have a plan for your retirement, because if you don't have a plan for what you're trying to do, that's like trying trying to build a house with no blueprint. It's absolutely going to be a disaster. Second of all, that is when you have to look at that plan, understand it, and then get the basics down. This is where you are basically getting your feet wet in the world of real estate after basically studying how others before you have used real estate to either become a millionaire or potentially reach early retirement. Now, during phase 2, you may not be ready to completely dive into your first real estate investment in terms of direct ownership. However, later on, I am going to tell you about today's sponsor, Fundrise, which is a way that you could still invest in real estate without all of those barriers to entry associated with a direct real estate investment. But more on that later on. Now, phase 3 is where you actually go out and acquire your first property. And so what a lot of people are going to end up doing, which is what I did myself, is you then renovate that property to actually add value to it. Now, after you do that, and assuming as well that the markets are in your favor, the fourth and final step is to do a cash out refinance, which is essentially where you pull your cash out of the property, and we'll talk more about that later, and then you can utilize that cash for another real estate purchase. So that's one of the questions people often ask is, where do people who own a ton of real estate keep getting all of this money to buy more real estate if you have to have, let's say, anywhere from $75,000 to $150,000 in cash to really get into a deal? Well, a lot of that cash, if not all of it, is just going to be coming from these cash out refinances that they're doing on other pieces of real estate that have gone up in value. So those are the overall 5 simple steps to early retirement through real estate investing. We're now going to break down each one more specifically. So first of all, let's talk about your plan for retirement. Now, the very first step in figuring out your retirement plan through real estate or any asset out there is basically figuring out how much money do you need. And you're going to do this by determining what level of monthly income is needed to basically cover your expenses. Now, of course, we are seeing record high inflation right now, so that is something you have to really account for as well, because it's something that people may have not thought of prior, and if you didn't plan accordingly, a lot of people are finding that they don't actually have enough passive income coming in each month from their real estate or portfolio, whatever it may be, to cover these rising costs for groceries, housing, etc. So what we're going to be doing is adding 30% to this baseline figure in order to combat for that inflation. Obviously, we're not going to see, 30% inflation. We certainly hope not, but, that is going to be a very big margin of safety built in. And now a big factor that's going to come into play here is considering the lifestyle that you want, because obviously if you're looking to retire as a owner occupant tucked away in one of your rental properties, living rent free, well then you're going to need a very minimal amount of money to do that. But if you're looking to retire in a $1 million beach house that is passively paid for by your rental property empire, well, that's going to require a lot more real estate. So understanding where you're trying to end up is actually kind of the first step here, because that's all going to factor into how big you need to go in terms of scale. Now, when you're figuring this out for yourself, I would recommend actually sitting down and looking at the numbers. And of course, we are going to account for inflation by adding 30% to whatever you come up with at the end. And that is going to be how much money you want to be making post-tax every single month in order to have early retirement from real estate. Now, when you're going through this, you're going to want to make sure you have tracked all of these possible expenses. So I'm not going to go through all of these, but if you look at this screen right here, this is going to be money of the most common expenses that you have. So what I recommend doing is writing all of this down yourself and figuring out how much money that is per month, adding 30%, and that is the desired amount you'd be looking to make from your rental property. And that's going to be the desired amount of money you're making after taxes as the cash flows from your rental portfolio. Now, the other thing to consider as well is that real estate is a very good hedge against inflation. inflation, especially rental properties, because as costs go up, you are able to increase rents as well. So many people may argue that if you had $10,000 of monthly cash flow from rentals, that's not going to basically buy nearly as much in 10 years, but it's not going to be the same $10,000 of cash flow at that point in time. It's going to be probably $15,000 or $16,000 because of the rental increases every couple of years based on inflation. So once you have an idea of where you're trying to end up in terms of your monthly after-tax cash flow from your real estate, next you have to really get the basics down before you go out there and buy your first piece of real estate. We're also going to be talking about some different ways to invest in real estate in a more diversified manner later on. And this can be one of the best ways to get the basics down because you can learn about real estate and get into the game without having such a large financial commitment into one singular real estate deal. So let's now talk about what's involved with getting ready to invest in your first real estate deal. Well, first of all, you have to save up a very large sum of money, so you need to practice good personal financial habits. So you're going to have to track all of your personal spending, spend as little money as possible, and hoard cash. Now, no, I'm not talking about physical cash. Of course, there's different places to put your money via, online savings accounts, etc. But what I'm getting at here is you can't be frivolous with your money if you're trying to build a real estate empire. So you're going to have to be very disciplined with every single money decision that you are making out there. Now, beyond just tracking your spending, you're also going to need to develop a plan for how you're going to save up such a massive sum of money. And before you even begin saving up for that real estate purchase, you need to make sure you have your emergency fund covered, because if you run into an emergency expense or lose your job or something, that could be detrimental to your real estate career if you basically run into trouble on your very first property. So before you even save up for that first property, it's imperative to also have your 3 to 6 months of expenses in a separate account for emergencies only. And then the all-important credit score. Guys, I started building my credit when I was literally 18 years old. The day after I turned 18, I got my first secured credit card. And that's what helped me a lot with getting into real estate at the age of 25, my very first real estate deal. Now, obviously, if you aren't that age now, that's not something you can do. But what you can do is start working on your credit right now, because it is going to take a little bit of time, especially if you have to dig yourself out of any kind of hole, but you can do wonders to your credit in a very short period of time. So this is a great area to focus on initially. And then something else you're going to want to consider as part of this plan is when you are going to be reinvesting the rental income versus when you are going to be cashing it out and using it for your personal expenses. Because what you're going to find is that most people, if not all of them, who are successful with real estate, it's those who treat real estate like a business. And so what that means is using all rental income or income derived from the business to reinvest back into the business, either updating existing properties or acquiring new ones. And then you would use your own primary income, whatever that is, the income from your job, etc., to cover all of your personal living expenses. I know a lot of people want to be generating cash flow from their real estate, sticking in their pockets, and then spending it, but that is the worst possible thing you can do if you're actually trying to retire early and do anything at a scale beyond just one or a few properties. Every single one of the people that I know that own more than a dozen units of real estate are extremely frugal and dialed in on every penny in both their personal spending and their business spending. And those are the exact types of people that end up being successful in real estate because of how dialed in they are with their personal finances. That is what it takes to properly do this. So now let's talk about acquiring your first property using my favorite strategy, the one I used myself, an FHA loan followed by a rehab. Now, what's cool about the FHA loan is it allows you to get into the real estate game without having a massive down payment. And this can be as little as 3.5% down, which is what I did on my very first real estate investment back in 2019. So this is how the FHA to rehab plan works. Well, after you find the right property, you're going to acquire an FHA loan, which is typically going to require 3.5% down plus closing costs. Now, one of the options that you have is you can actually take out an additional amount from your loan to put towards your closing costs. That's what I did myself on my very first loan. And so that allowed me to secure a rental property that was $459,000 with just a $22,000 down payment. Now, in order to do this, you're going to need a credit score of at least 580, but these days you're going to want one that is much higher with how competitive this real estate market is. Now, once you have gone through the loan process and actually purchased the property, you're going to live in one of the rental units, which is going to allow you to eliminate your biggest housing expense, which is whatever you're currently paying for rent. And then the goal here is to have the other tenants in your building paying most, if not all, of the rest of the mortgage, allowing you to basically live there for free while having them pay down your mortgage. And if that's not possible through renting out just the units themselves, what a lot of people will do is also rent out a spare bedroom in the unit they are living in to a roommate, especially if they are living the single life at that point in time. That can be a way to get closer to that goal of having the entire mortgage paid by your renters. And then you can simply just do that if you want to, and then allow your real estate to appreciate over time. Now, the one downside to this FHA strategy is that you are going to pay PMI, which can be a significant cost. And this is an insurance to basically protect the bank because you have such a small amount of equity in that property. So the insurance really doesn't benefit you at all. It's just a requirement if you have a loan with that little equity. Now, what you can do is actually refinance into a conventional loan, which is exactly what I did with my multifamily property. However, that was after I did a $60,000 upgrade to the property itself. So before you do a refinance, it's recommended that you give the property a number of years to appreciate, or you do some type of major value add to the property. But at that point in time, you can refinance and eliminate that PMI and have a lot more equity in your loan, which can bring down your mortgage costs significantly. So earlier we talked about how the cash out refi is really the secret to how people acquire so much real estate out there. So now we're going to dive into that much deeper so you have a better understanding of how that works. So a cash out refi essentially allows you to use the current equity in your home to go out and buy a second property. And that is accomplished by taking out a new loan on your property for a larger amount, cashing out on the difference between that and your old loan, and using that amount of money for the down payment. So the best way to understand this is to look at an example. So let's go over an example of a cash out refi now. Let's say you have an original loan here with a purchase price of $300,000 with a down payment of 3.5% being that FHA loan, and your mortgaged amount being $289,500. And then after that, let's say you do a $25,000 rehab and you let some time go by, allowing the property to appreciate. And let's say all of that rehab was you doing it yourself, so there was a lot of sweat equity built in. Well, now let's say the appraised value comes in at $450,000. Well, in order to go from an FHA loan to a conventional loan, you need to get to at least 20% loan to value. And on that new $450,000 appraised value, that means that you could mortgage $360,000, which would be your new loan from the bank. Now, I know this idea of taking out a larger loan might sound crazy, but it's probably not going to be that big of a difference in terms of your overall payment, because the biggest dictator is usually the interest rate and then whether or not you actually have PMI involved in that loan. So even though you may be mortgaging a larger amount of money through a cash out refi, you could be saving yourself monthly based on the interest rate and or eliminating that PMI. Not to mention, being able to use that money to create additional cash flow elsewhere is probably going to offset any difference in the monthly cost on that initial property. So your original FHA loan had a mortgage of $298,500, and we're assuming that it wasn't even paid off in the meantime, which you would have had some of it paid off during the time that you owned the home. But we're strictly just looking at it from a standpoint of the original loan compared to a new loan. Well, going out and getting this $360,000 loan on the new property would allow you to cash out $70,500 in the process. Now, of course, you do have to factor in that you did spend $25,000 on the rehab, and there are going to be costs with every closing. We said it's going to be roughly 3%, so we're figuring $8,000. But in this case, you would still be making out with $37,500 plus eliminating PMI, which would save you at least a few $100s per month in most cases. And then you could use that $37,500 to get into your next real estate deal. So that is how you can use the cash out refi to go from a FHA loan to a conventional. And so far we're talking about the exact step-by-step process that I personally followed with my own real estate investment. Now, what I have decided not to do is scale from here because I like to personally focus my time more so on my actual digital businesses versus a real estate business. But if you wanted to scale, this is how you would continue doing this through the strategy of rinse and repeat. Well, as we mentioned earlier, most, if not all, successful real estate investors are following a proven strategy. They're not reinventing the wheel or doing anything that is truly that unique. In fact, most out there are following the BRRRR strategy, which we are going to cover right now. And this method allows you to accelerate your retirement time horizon by maximizing the value that you can capture through your existing real estate. So step one to this property is to go out there and buy something that needs a little bit of work. Specifically, you're looking for a property that doesn't need any major work. You know, we're talking like a roof or structural work, etc. But it needs something to where your average homeowner isn't looking to, take that project on, and it's not what you would call turnkey. At that point, you're going to be doing renovations on the property, and you're usually looking to spend under $50,000 in most cases. Then you are ideally going to be able to rent out that property for top market value because it's all nice and sparkling clean, and it is going to be an attractive rental unit. And then after that, usually about 1 to 2 years has gone by anyway through this entire process, especially if you're doing the work yourself while living in one of the other units, and that is when you are able to do a refinance. Now, you don't always have to let a lot of time go by, because if you do a lot of work on the renovation side, you can add tons of value to the property. Or another strategy that some people that I know follow is by actually adding value by creating additional bedrooms within the units. So for example, one of my friends bought a large building that was all 2-bedroom, 1-bathroom apartments, but they had a way to go in there and renovate it and turn those all into 3-bedroom apartments, making them more valuable in terms of what they could get for monthly rents. So then at that point, you're going to do a cash out refi, just like we talked about, in order to get your cash out of the property to secure another mortgage. And then you're going to repeat this process every 1 to 2 years. And the interesting thing here is that every time that you acquire a new property, the cycle is going to happen faster and faster, because if you're reinvesting all of your business profits, which is what you should be doing if you are looking to be serious with real estate, well, every time you add a new property, there's going to be more cash flow, which is just going to allow you to build up a sum of money faster and faster to get the next property. So that is how you can reach early retirement through real estate investing, by following this proven strategy. But even so, you still need to have tens of thousands of dollars saved up in order to get involved with your very first property. And if you're trying to satisfy step 2 of this plan and learn about real estate before getting into your first property, well, let's talk about today's video sponsor, Fundrise, which is a great option for doing just that. So Fundrise provides an alternative real estate option to those who may not have tens of thousands of dollars to get into their very first property yet, but they also might not be interested in buying, real estate through the stock market in the form of a REIT. Fundrise allows you to get all of the benefits of private real estate ownership without all of the headaches that were normally associated with this asset class. With Fundrise, you can hedge against inflation by leveraging one of 5 unique investment plans to own shares of diversified real estate portfolios across the United States. In addition, it is very quick and easy to set up, where you can get started with Fundrise in just minutes. Another thing to consider here is that you have a high level of diversity with Fundrise because you're investing in a portfolio of dozens of different properties in most cases, if not hundreds of them. When you go out and buy your first real estate property, if you don't do the research and you buy in the wrong market or wrong neighborhood, you're not diversified. So if you have a bad experience, that could be detrimental to your real estate career. In 2021, although it was an uncertain year, Fundrise investors were rewarded handsomely with a 22.9% return. There's over 300,000 active Fundrise investors with over $7 billion in total real estate transactions to date, and so far over $160 million has been paid out to investors in dividends. Now, one of the things I like the most about Fundrise is you can automatically reinvest your dividends, which is exactly what we were talking about earlier of reinvesting your business profits in your real estate empire. So Fundrise has proven to be a great investment over the last few years, but even so, right now is actually a time where Fundrise is very well positioned based on the current economic environment. So we now know that the biggest concern that most people have right now related to the economy is inflation, but real estate is a really good hedge against inflation because number one, it tends to go up in value with rising prices, and number two, rents can be increased to offset inflation or rising costs associated with owning that real estate. Second of all, you're able to capitalize on these high demand areas that have popped up across the United States, and that is because your Fundrise portfolio is made up of well-located properties in top sectors. So you are investing in the most prime real estate locations based on proven research and analysis. And that, of course, contributed to that 22.9% overall return that Fundrise investors experienced in 2021. And of course, you can get set up in as little as 10 minutes and begin owning real estate in just a matter of minutes. So if you guys want to check out Fundrise, there is going to be a sponsored link at the very top of the description, or there's going to be a pinned comment down below as well. Lastly, let's go ahead and jump into the Fundrise app on my phone to go ahead and look at some live deals right now. Okay guys, so here we are inside of the Fundrise app itself. So let's now go ahead and check out some current projects within the Fundrise portfolios. So what's great about Fundrise is that you can get transparency into each individual project, and all you have to do is click on a property to learn more about it. So this particular property right here is a stabilized commercial building in Los Angeles, California, which is part of the flagship real estate fund, but you can also get exposure to this through the East Coast E-REIT. So each Fundrise portfolio is going to be comprised of these different funds and E-REIT products. This particular property is an investment size of $24.5 million. Now, actually getting started with Fundrise is a very simple and streamlined process. Let me show you how to do that now. So it all starts with a quick questionnaire about yourself where you're going to fill in some basic information like your age, as well as your overall experience with investing, and then where you get your advice when it comes to investing. After that, they're going to ask you a couple of more questions that are going to help you understand what Fundrise portfolios may be the best fit for you. And they're also going to ask you how long you plan on holding on to your investment. Then they're going to ask you how much money you plan on contributing over time. And based on all of that information, they're going to give you a tailored recommendation. So if you guys want to check out Fundrise on your own, be sure to use the sponsored link down below, or you can visit fundrise.com/Ryan Scribner to begin investing in real estate. Thank you so much for tuning into this video. I hope you guys enjoyed it. If you did, make sure you drop a like, as well as hit that subscribe button for future notifications. Hit the bell if you want all of those notifications. And as always, guys, I hope to see you in the next video.